Hey guys, welcome back. This is chapter 5, and it's dealing with CVP, cost volume profit relationships. Um, so, when we talk about cost volume profit, this analysis really examines the relationship between cost and sales volume and profit in order to support the decision making of managers. Some of the key components: sales price per unit, revenue generated per unit, the variable cost per unit. Cost would vary directly based on the sales volume. Fixed costs, these are costs that are going to remain constant regardless of your activity level. So it's more of a variable kind of component. As to when you start out, going down a road, you don't really know how much you're going to sell at times, and there's some variation in that. You could have a better or worse month than expected, and so really trying to understand the relationship between cost, volume, and profitability. So there's also a contribution margin, which is a really important concept. It really helps you get your break-even point and things like that. But uh, this is basically the amount remaining from sales revenue after covering your variable costs. So let's say you have $100 part, it's $70 to make it. Then you or $70 of variable cost to make it. Then $30 of that is going toward your $3,000 fixed cost for rent. So if you sell 100 units of that, 100 times 30, you would end up ending up with enough money to cover your rent for the month. So that's really what we're looking at there is that cost volume profit, and then the contribution margin really tells you how much you're contributing on the sale, how much you are contributing on the sale of every item toward your fixed cost. That's really what you're doing. That's why it's called contribution margin. So it's the definition is that it's a percentage of sales revenue that contributes to fixed costs and profit. So you could actually say, hey, I want to cover all. My break-even point is getting here to uh, my break-even point is going to be how much do I want to spend in order to cover my rent, but my target profit is $30,000 a month over that. So now, how many do I have to sell in order to hit my fixed cost and this? And then that's my target objective, and that goes out to my sales staff and everybody else. We're shooting for that number. We need this many units to hit that number, and that's one way to sort of project and things like that. The break even point is basically the sales level at which total revenue equals total cost, resulting in zero profit. The break even units would be your fixed cost divided by your contribution margin per unit. And that, if you divide your fixed cost by that, it gives you the number of units you need to break even. For dollars, if you want it in dollars, maybe you can make a different margin. It's not just cut and dry on the number of units. There's different profit in there. Then your break-even sales dollar amount would be your fixed cost divided by your contribution margin ratio itself, and that would give it. So, an example: if your sales price is $50, your variable costs are $30, and your fixed costs are $20,000. Your contribution margin would be, so write those numbers down and then write them out as I'm saying it. Contribution margin would be $50 minus $30 equals $20 per unit. That's your contribution margin. Every unit you sell, you're contributing $20 toward your fixed costs and profit. So your contribution margin ratio would be $20, that amount divided by your $50 sales price. That means 40% of everything you sell is going directly toward your contribution margin, and your fixed costs, and your profitability. So your break-even units would be in that case $20,000 because that's your fixed cost, and you divide it by the $20 contribution per unit, and you get 1,000 units. So you sell 1,000 units, you pay your fixed cost. Your break-even sales point would be $20,000 of fixed cost divided by the 40% ratio of your contribution margin to your sales price. 40% of everything you sell is going toward your fixed costs. So in that case, it'd take $50,000 in order to break even. from a sales dollar standpoint. So it's 1,000 units or it's $50,000 total. Um, CVP analysis, forecasting on unit sales. So the target profit analysis. This would calculate your sales needed to achieve a specific profit target. So a formula in units would be your sales volume equals your fixed cost plus your target profit. That's sort of what we were talking about, divided by your contribution margin per unit. The formula uh, for sales dollars would be your sales revenue would equal your fixed cost plus your target profit parentheses divided by your contribution margin ratio. So example, if your target profit is $10,000 and your fixed costs are $20,000 and your contribution margin is $20 per unit, that's the per unit margin, not the percentage. Your sales volume would be $20,000 plus 10,000 parentheses divided by $20 equals 1,500 units. So you need 1,500 units sold. 1,000 broke you even. 1,500 units would break you even and give you a $10,000 profit. So if that's your target, you need to sell 1,500. Anything more than that is better profit. Anything less than that is worse profit. Sales revenue would be $20,000 plus $10,000 divided by the 40%. So then that would end up giving you $75,000. And so what that tells me is basically 30,000 divided by 40%. That tells me I've got to sell, instead of $50,000 in dollars, I've got to sell 75,000 now in order to break even. A margin of safety it really measures the buffer between actual sales and break even sales. So the formula for margin of safety would be your actual sales minus your break even sales. So example, if actual sales are 60,000 and break even was 50, your margin of sales was safety was $10,000. CVP analysis, when we expand our focus to four profit levers, there's sales volume, which basically it's a way that we generate more revenue, more or less, but it's one of the profit levers. It increases the number of units sold. Sales price ends up raising prices if the market allows it. Your variable cost, they end up reducing cost per unit. Maybe it's through efficiency or even supplier negotiations. You come up with different ways to end up reducing those variable costs. And then your fixed costs, these would manage or reduce fixed overhead expenses. So example, um, say a current profit is 10,000. Some strategies to improve that profit. Maybe we want to increase our volume by about 10%. So our volume grows to 1,100 units. That increases our profit. Um, Maybe we want to decrease our variable costs by $1 a unit. That profit would increase as the contribution margin rises because now you're contributing more and a higher percentage of every sale to your profit. Um, let's say we reduce our fixed cost by $2,000. That's a direct increase in profit as well. So, some insights for managers to consider is to identify what lever would have the greatest impact to optimizing profit. If you can figure that out as a manager, and you can really start honing in and saying, if we can fix some of these areas right here, we'll be a better company. That's really important insight. So multi-product break-even analysis. So this extends CVP analysis to companies with multiple products by considering the sales mix. So when you talk about a sales mix, not every product is worth the same in profitability. Some get, some you get a higher profit margin than others, and that may want you to change the way you're focused as a company on the items that you're trying to sell. So it's the sales mix is a proportion of total sales represented by every product. You may have 10 products, one represents 12% of profitability, one 6%, whatever it is, but it gives you a mix, a sales mix. Um, so we look at our weighted average contribution margin. So the average contribution margin per unit weighted by sales mix. So the formula for this would be the contribution margin of product A, whatever that is, times the sales mix of A, plus the contribution margin of product B times the sales mix of B. Um, the break even point, it would be your break even units. What that would be is taking your fixed cost and dividing that by your weighted average contribution margin. Then the sales mix is used to allocate break even units across products. So for product A, the contribution margin, let's say it's $20 per unit, and the sales mix is 60%. So 60% of everything we're selling is related to product A. Product B would be the contribution margin would be $10 per unit, and the sales mix would be 40%. So our weighted average contribution margin would be $20 times 60% plus $10 times 40% would be $14. That's our weighted average contribution margin. So our fixed costs are 28,000. So our break even units would be 28,000 divided by $14, which would be 2,000 units. So if we allocate that based on our sales mix, then product A, which would be 2,000 units times 60%, means we need to sell 1,200 of product A. And then in product B, we would have 2,000 times 40%, means we need to sell 800 units there. So this really helps managers understand the impact of product mix on profitability and make informed or better decisions on production and marketing. Summary. CVP analysis, very foundational tools, break-even analysis, and contribution margin will end up providing key insights for decision making. Forecasting unit sales, target, profit analysis, and margin of safety really help managers assess sales goals and risk. And it also expands the focus. So there's four profit levers. There's volume price, variable cost, and fixed cost, which help guide profit optimization strategies. There's also the multi-product break-even analysis. This incorporates sales mix and weighted contribution margins for companies that have diverse product lines. So hopefully this helps you guys sort of understand the CVP analysis. It sounds more complicated than it is, but it's extremely useful. This is the kind of information that can really set your company apart and help you know the numbers. How much do you have to sell to be profitable? How much do you have to do to of each product in order to make your desired results? This is quantifying your business. So very good, very useful information. Hope you guys liked it. If you have any questions, just reach out to me. I'll be glad to help. Take care.